Welcome to the probability brief for Monday, March 2, 2026. The liquidity drift and the regulatory horizon, decoding the synthetic squeeze. The probability brief is the signal check on the world's most telling prediction markets. The probability brief's objective is to deliver clear, data-driven intelligence on how major events are being priced in real time. Each episode examines fast-moving prediction markets, high-impact whale trades, regulatory momentum, and shifts in crowd psychology. The show explains what moved, why it changed, and what the probabilities reveal about the path ahead, making complex market signals accessible, actionable, and easy for listeners to follow. In today's briefing, we aren't just reporting the news, we are dissecting how the world reacts to it by diving into probability ecosystems and the hidden incentives driving the tape. We are looking at a market that is currently grappling with a massive repricing of geopolitical risk and a sudden shift in the incentive map regarding distributed energy integration and carbon credit verification. Signal mechanics: why a narrative collapses overnight. We begin today with signal mechanics, where we analyze how information propagates through the market. Over the last 48 hours, we witnessed a total collapse of the late Q1 rate cut narrative. On Friday, prediction markets like Kalshire and various offshore probability ecosystems had priced a March interest rate reduction at a 62% probability. By 8 a.m. this morning, that probability plummeted to 14%. Why does a narrative collapse this abruptly? It isn't always a single headline, it's often a liquidity drift fueled by information asymmetry. In this instance, we observed several whale trades, positions exceeding $5 million, beginning to offload yes contracts at 11 p.m. last night. This created a cascade. In prediction markets, liquidity is often thinner during off-hours, meaning large trades move the price disproportionately. Retail traders woke up, saw the odds shifting, and assumed a regulatory leak had occurred. This is a prime example of crowd psychology amplifying risk. The crowd reacts to the price movement itself, treating the move as the signal, rather than the data that caused it. In reality, the data was a subtle shift in the Federal Reserve's overnight reverse repo usage, a quiet signal that most traders missed. Market microstories: the 2 a.m. synthetic squeeze. In our market microstories, we look at small but meaningful movements that serve as teachable moments about incentives and market structure. At approximately 2:15 a.m. Eastern Time, a niche market tracking the approval of the New Jersey offshore wind expansion saw a sudden 8% spike in probability. On the surface, an 8% shift in a niche market seems like noise, but our analysis reveals a synthetic squeeze. A single participant attempted to hedge a physical energy position by buying up available no contracts. Because the order book was thin, they cleared out the first 5 levels of asks, causing the yes price to artificially invert for nearly 15 minutes. For the savvy observer, this was a mispriced market correcting itself. It revealed that smart money is currently using probability ecosystems not just to speculate, but to insurance hedge against physical project delays. When a market is mispriced like this, the incentive for a liquidity provider to step in is massive, and we saw the market return to its mean within the hour. Structural context: pricing geopolitical friction. Moving to structural context, we examine how markets price escalation during periods of geopolitical tension. Currently, the maritime dispute in the South China Sea has entered what we call a volatility cluster, a period where market prices swing wildly as they struggle to find a new equilibrium. While traditional equity markets are trading sideways, the prediction markets are showing a divergent signal. Probability markets tracking kinetic conflict before June have risen from 5% to 12% over the last 7 days. However, the trade volume impact markets, which track the actual flow of goods, have remained steady. This tells us that traders are pricing in geopolitical friction, such as increased insurance costs and slower transit, rather than a structural fracture like a total shutdown of trade. The crowd is betting that the economic incentives for both sides to keep trade flowing are currently stronger than the political incentives for escalation. Crowd psychology deep dive: narrative anchoring. Crowd psychology is a goldmine for understanding why markets move the way they do. Today's deep dive is on narrative anchoring. We are currently seeing a massive overconfidence cycle in the AI sovereign wealth fund markets. Traders have anchored to the idea that a specific G7 nation will announce a multi-trillion-dollar AI infrastructure fund by the end of the week. Despite zero confirmation from official sources, the yes contracts are trading at 85% probability. This is a classic confirmation cascade. Traders are only looking for news that supports the big fund theory, while ignoring quiet regulatory filings that suggest the Budget Committee has already deferred the discussion to 2027. The attention scarcity in this market means that the sober, boring budgetary reality is being suppressed by the high dopamine big announcement narrative. When the reality eventually hits, the resulting panic dip will likely be severe as the anchor is ripped away. Regulatory trajectory analysis. Decoding agency signals. In regulatory trajectory analysis, we don't just report a regulatory move, we break down the legislative process and agency signals. We are currently tracking a significant shift in the SEC's stance on synthetic prediction assets. By interpreting agency signals, specifically the change in tone in the latest staff accounting bulletin, we can see that regulators are moving away from total bans and toward a stakeholder incentive model. Historical analogs from the 2010 Dodd-Frank implementation suggest that when an agency starts hiring market structure specialists at the rate we saw last month, a formal notice of proposed rulemaking is usually 30 to 45 days away. Traders who understand this timeline are currently front-running the market, buying regulatory clarity contracts while they are still priced as high-risk gambles. This is how sophisticated players exploit information asymmetry before the general public catches on. Market memory, how the last cycle informs the present. Prediction markets have memory, they remember how they mispriced past events and how long narratives usually persist. In our market memory segment, we look at the 2024 election cycle as a guide for today's volatility. Back then, markets drastically mispriced the impact of late-breaking polls, leading to massive corrections in the final 72 hours. Today, we are seeing a similar pattern in the carbon tax legislation markets. Traders are hesitant to push probabilities above 70% because of the memory of how a similar bill collapsed at the 11th hour last session. This lingering narrative persistence acts as a psychological ceiling on the market, preventing it from reaching a true consensus even when the data looks favorable. Cross-market correlation, the semiconductor ripple. In cross-market correlation, we look at the when-then relationships between different domains. When sentiment shifts in one market, another almost always reacts. Currently, we are seeing a strong correlation between semiconductor futures and global educational technology prediction markets. When Market A, semiconductors, experiences a supply-side shock, Market B, EdTech adoption, usually follows with a 3-day lag. This is because the market prices in a delay in hardware rollout for large-scale school contracts. We have noticed that when liquidity dries up in the traditional tech sector, it often appears in these niche prediction markets as traders look for higher alpha opportunities where the signals are less crowded. The incentive map, the silence of the labs. To truly differentiate our analysis, we look at the incentive map. This segment asks, who benefits, who is signaling, and who is silent. In the current debate over the Open Source AI Safety Act, the most telling signal is the silence of the top 3 Silicon Valley venture labs. Usually, these entities are vocal in their opposition to restrictive licensing. Their current silence suggests they may have already coordinated with regulators to secure grandfather clauses for their existing portfolios. If you are a trader betting on a regulatory rollback, you are likely on the losing side of this incentive map. The winners here are the incumbents who are signaling compliance to pull the ladder up behind them. What traders missed, the carbon verification pivot. Finally, we look at what traders missed this week, the quiet signals and early signs of narrative decay. While everyone was watching the headline-grabbing Senate hearing transcripts on social media algorithms, there was a subtle shift in liquidity in the voluntary carbon market derivatives. A quiet regulatory filing from the Department of Agriculture last Thursday introduced a new data integrity standard for soil-based carbon credits. This is an undervalued signal. It effectively invalidates about 40% of the credits currently being used by Fortune 500 companies to claim net zero status. The probability markets for climate compliance fines haven't moved yet, but the underlying liquidity for those companies is beginning to dry up. This is an early sign of narrative decay for the easy ESG era. Episode summary and closing. In simple terms, today's signals point to a market that is increasingly sensitive to quiet data over loud headlines. We saw how a narrative can collapse in hours when whales exit, why niche liquidity spikes reveal hidden hedging strategies, and how the silence of major stakeholders in the regulatory space is often the loudest signal of all. The lesson for today: watch the plumbing of the market. The liquidity and the incentives, because that is where the true probabilities are formed long before they hit the headlines. Thank you for listening to the Probability Brief. If you found this valuable, please like, subscribe, follow, and share with someone who watches the odds like you do. The sources for today's episode are Polymarket, Bureau of Labor Statistics, Twitter Trends, and Senate hearing transcripts. This podcast is for informational purposes only and does not constitute financial, investment, or betting advice. All market probabilities are subject to change. Episodes may be generated using fully original, market movements, whale trades, regulatory signals, geopolitical dynamics, and probability ecosystem behavior. Some scenarios, market movements, or examples discussed in this episode may be illustrative or simulated for explanatory purposes.